Welcome to the Teaminvest Wealth Builders podcast, where we bring you insights, strategies, and stories to help you build and compound your wealth and knowledge. I'm Kerry Fleming, your host for this exciting series. Whether you're a seasoned investor or just starting your wealth building journey, this podcast is designed to inspire, educate, and empower you. Let's get started. Division 296 tax is an additional 15% tax on the earnings related to the portion of your superannuation balance exceeding $3 million, which sounds fairly straightforward. However, there are some nuances to this proposed tax that has left people with some concerns. To talk through this proposed tax, we've invited Tip Group's head of self-managed super fund, Meleena Mitchell. Meleena is a CPA and brings over 15 years of experience in helping clients navigate the complexities of superannuation. Whether it be starting your self-managed super fund restructuring, annual compliance and lodgment of tax returns, assistance with super strategies, which includes estate planning, legislative compliance, or self-managed super fund wind-up. The information contained in this podcast is of a general nature and is not intended to address the objectives, financial situation, or needs of any particular individual or entity. It is provided for informational purposes only and does not constitute, nor should it be regarded in any manner whatsoever as advice. It is not intended to influence a person in making a decision. No one should act on such information without appropriate professional advice after a thorough examination of their particular situation and needs. Hi, Meleena. Thank you so much for joining us today. To start off, I'd love to ask you, what is Division 296 tax?
Hi, Kerry. It's lovely to be here today. Okay, so Division 296 tax is the additional 15% tax on earnings above the $3 million super balance. Now, the legislation has not passed through Parliament yet, and it was proposed to come into effect on the 1st of July 2025. So since the election, the bill will be reintroduced in the upcoming Parliament from about the 22nd of July 2025. So we're going to watch the space because nothing's been legislated yet. And just remember that Division 296 tax is a personal tax. So the tax is not charged to your super fund. It is taxed to you personally. So you will get an assessment. But if you don't have the money to pay the tax, you can elect to have the tax paid by the super fund. You just need to go through the process and get an authority to release a payment from the ATO.
Okay, so that says to me, if you're someone that has those sort of balances within your super fund, this is something that you really do need to be aware of. So on that thought, how is the tax actually calculated?
Yep, there's about 4 steps to this calculation. The first step is we've got to determine your total super balance. So your total super balance is all your super balances across multiple funds, if you do have multiple funds. And if they add up to $3 million or above, then we start thinking about how the tax is calculated. Secondly, if you do have over $3 million in super balance, we then need to calculate the earnings. And earnings is the growth in the super balance, and it's adjusted for your contributions. So we've got to take away your contributions and adjust it for withdrawals, which are pension withdrawals or release authorities. And we've got to add this back into the earnings calculations. Thirdly, we need to calculate the proportion that's over $3 million in a percentage. So this is the amount that's over $3 million divided by the current year total super balance. So if you're $20,000 over $3 million, then we got to take the $20,000 and divide it by $3 million and $20,000. That makes sense. And then lastly, we apply the 15% tax. So you take your earnings from step 2, multiplied by your proportions in step 3, and then you apply the 15% tax on this. We'll have an article on our website with an example to this, and we'll include the link to the show notes.
Absolutely. That will make it so much easier having it in the show notes, because that sounded like quite a calculation there. So you mentioned earnings. So can you just provide me with just a little bit of clarification of what's included in the earnings?
Yeah. So earnings is for the Div 296 tax. So it's in your investment income, which will be your dividends, distributions, interest, or any rental income, less your expenses, which will give us your net income. And then it will be included realized capital gains from any disposal of assets that you may have done during the year. It also includes your tax refunds, so franking credit refunds, and it actually includes the growth in the fund's asset, which is also known as unrealized capital gains.
Okay, unrealized capital gains sounds a little bit concerning there. So I'm guessing that is a little bit of a controversial issue because that's not usually included in tax calculations, is it?
Correct, yeah. Yeah. So unrealized capital gains, for those who don't know, is the increase in the value of your assets over time for assets that have not yet been sold. So for example, if you purchase shares for $100,000 and by 30th of June, it goes up to $120,000. So that $20,000 is what we call our unrealized capital gains. Now, under Division 296, unrealized capital gains is actually included as part of the calculations for earnings. So therefore, your unrealized capital gains is now caught up in this tax. And it's controversial because we don't pay tax on profits for assets that have not yet been sold, which then can cause cash flow issues. So if you haven't sold your asset, you don't have the money technically to pay for the tax. Other issues such as complex valuations. So if you have an SMSF with properties such as agricultural properties or private investments such as private companies, valuations can be quite hard at 30th of June and also can be quite costly. And lastly, another controversial issue is setting precedents for taxing unrealized capital gains outside of the SMSF or outside of super environment, such as companies, trusts, your personal investment portfolios could come under fire in the future if all of this goes through.
So the tough bit, which is what you're highlighting there, is when we start taxing unrealized capital gains, it means that we have to really get, we really have to have the cash flow somewhere else to be able to pay that tax because the gain isn't realized, which means that you haven't actually sold down the asset yet.
Correct. Yeah. Yeah. So it becomes a problem, especially, I guess, for farmers, or if your investment is held up in like startup companies where you have massive growth, but you don't have the cash to pay this tax. You could have massive growth, the tax could be huge, but if you're cash strapped, where do you get the money to pay for this tax if you can't pay for it inside your SMSF? And if you don't have the funds to pay for it outside of super, and if you have year-on-year growth, it will cause problems, I guess, for people who don't have the money to pay for this tax.
Yeah, which, as you alluded to, we don't want that to be a precedent for other areas where unrealized capital gains are starting to be included in our tax calculations. Okay, so moving on from there, usually when I'm paying tax, income tax, if I make a loss, then that's usually offset against future gains. But I understand that that isn't the case in this instance. Is that right?
Yeah. So if Div 296 tax does go through, and say we're in year 2 or 3 or 4 of this Division 296 legislation, and your super balance has dropped, but you're still over the $3 million threshold, you would have, I guess, what you call a negative earnings, which is a loss. So under Division 296 tax, you don't pay tax on the losses that you've made, even though you pay tax on it in prior years related to your investment growth, which have now disappeared. So instead, your losses will be carried forward to be offset against any future earnings.
So they will be offset in the future, any losses?
Yes, but you won't get a tax refund.
Right. Okay. So at least that's some positive news, right? So we also talk about, things get indexed each year. We talk about CPI, we talk about all of that sort of thing. Are they suggesting that this $3 million threshold will be indexed?
So in this current legislation, as it stands, the $3 million threshold won't be indexed, which obviously we know can have long-term implications, as more and more people will be affected by this $3 million threshold and this Div 296 tax. Because young Australians, with our compulsory super contributions and the effects of compounding over time, your balance will most likely increase to above $3 million over time. It could be maybe 2 to 3 decades. But if the $3 million threshold does not get indexed, a lot more people will be affected by this.
Absolutely. And I would suggest that, a lot of people that are affected now, or once this comes, or if this comes in, I should say, the people that would be affected immediately, a lot of them are probably within self-managed super funds. Is that kind of fair to say?
Yeah, I would say so. I mean, if you've got properties or, startup investments in your SMSF, yeah, that's going to grow over time. And eventually it will, your balance might be over $3 million, especially with effects of compounding and the compulsory super guarantee contributions.
So it makes it even more important to make sure that whoever it is that's helping you calculate your tax and do your lodgements and all of that sort of stuff with your self-managed super fund, making sure that you've got someone there that understands all of these rules and these legislations, to make sure that everything stays compliant with your self-managed super fund. So is there anything that we can do? So if I'm edging close to 3 million or I'm over 3 million within my superannuation, what do I do?
All right. So firstly, just remember that right now the legislation hasn't passed through Parliament yet, but we can start by having a look at your assets in your SMSF, especially if you've got properties, unlisted investments such as trust or companies. It's important to get your valuations done and up to date for 30th of June 2025. So once that's done, if you've got balances about $3 million or over or close to, start thinking about things such as equalizing your super balances between spouses, especially if one person has a higher balance than the other. Another thing is maybe start thinking about transferring some of your balances to the next generation, whether it be your children or your grandchildren. This would then help with estate planning. It could, I guess, decrease the death taxes that could be paid by your estate if you kind of transfer the balance now. But all of this is subject to obviously meeting a condition of release, assuming you're already on a pension. And if you're depositing money for your spouse or your children, you also need to consider the ability to accept contributions as well, because this is obviously mandated by your age and your total super balance as well.
So just to reiterate, as we said at the beginning, this isn't financial advice. These are basically just suggestions or different things that are potentially available, different strategies that are potentially available. So we obviously don't know your specific circumstance or situation. So please make sure that you have a look and review anything that you're thinking about with a trusted advisor, with your trusted advisor. But this could be a good trigger to have a review of what your situation is, having a look at what your current investments within your self-managed super fund or within your superannuation in general are, and do a review. Meleena, thank you so much for your time. And as we mentioned at the beginning, you're head of our self-managed super fund division here at Tip Wealth. We mentioned that you were able to help establish self-managed super funds, but you're also able to look after the ongoing compliance and the annual lodgements for self-managed super funds. So if we have anyone in the audience that's looking to either start up a self-managed super fund or to needs help with the ongoing management of their self-managed super fund, what's the best way to get in contact with you?
So you can reach out to me via email on smsf@tipgroup.com.au, or go to our website and there should be a form and you can just fill out any queries via the website as well.
Wonderful. And we will have those links available in our show notes as well. Look, thank you for joining me today, Meleena. We really appreciate it. And all the best with the new financial year.
Thank you for having me.
Thank you for joining us on this episode of Teaminvest Wealth Builders. We hope you found today's discussion insightful and inspiring. If you know anyone else who could benefit from hearing this episode, please hit the share button and pass it on. If you'd like to learn more about Teaminvest or our unique investment approach, visit us at teaminvest.com.au. And please don't forget to subscribe to the podcast for more episodes. Until next time, stay informed, stay invested, and keep building wealth.